Kaustubh Gupta, co-head fixed income group with Aditya Birla Mutual Fund joins us, and let's take the conversation forward. Kaustubh, can you break down for our Indian viewers that how should one read into last night's events and what does that mean for the debt and equity portfolio?
Yeah, thank you, Nikunj, for the time. Look, markets all this while they have been pushed by policymakers that interest rates are likely to remain higher for longer, and which is what market was hoping that yesterday Fed will likely to push back markets against any preemptive easing in financial conditions. But what surprise which came to the market was there was no pushback by Fed in terms of assessment of rate cuts that markets were pricing. As a matter of fact, Fed is saying that they will cut rate 3 times, but market is already pricing in 5 times. Second, incrementally Fed also indicated, or rather Powell also indicated that incremental discussion in the Fed meeting will be with regard to the appropriateness of how tight the conditions are and when they want to dial back on their hawkish stance, which has been the flavor in last 18 months. Third, Fed also indicated that they will not like to wait for core PCE to come at 2% and to some extent experiment with overshooting of financial conditions. In nutshell, Fed clearly came out with a lot more dovish than what markets were pricing in. Now, our understanding is that as of now, what Fed is trying to do is they're trying to go for a big trophy, which is they're trying that US economy actually does a soft landing. There has been reasonable apprehension by the market that whether US Fed can engineer the soft landing. But with this move, given that the inflation is likely to slow down, and the consensus estimate was that for 2024, the global growth will slow down. This move, given that it will lead to some bit of easiness in the financial condition, I think the probability of soft landing has gone up quite substantially, and which is a good news for all risk assets, whether it's bond or it's debt or equity. From emerging market perspective, up till now, emerging markets hands were tied up in the sense that they were, or their policy stance were a lot more focused on ensuring the financial stability, and so is with RBI. But this early pivot by the Fed will give a lot of breathing space to some of the emerging markets to focus back on their local growth inflation dynamic. And in a sense that this is a great news for all emerging markets if Fed actually turns out what markets are already pricing in already and inflation doesn't misbehave incrementally.
So how do we know that this rate cut will ignite flows back into the market? Is there evidence which says that if interest rates by Fed come down by 50 bips, this is the inflow into emerging markets? And if interest rates cut is 75 bips, the inflow will increase by X percentage. Is there any way in which we can establish that? On paper, what you're saying is perfectly right, but is there evidence to back that?
If you look at drivers, because how the emerging markets they are connected with these developed markets is largely through currency channel, and the driver of currency has been historically valuation, real yield differentials, and real, you can say, the relative differential in productivity growth. Now, valuation wise, US dollar is very expensive. In our assessment, it is at least 15 to 20% more expensive than what trade will or the trade indicators will look about. As a matter of fact, US runs very large current account deficit, and relatively, because emerging markets, they have by and large run very conservative policies, their currencies are much well behaved compared to the historical instances of 2000 and prior. The second thing is that in terms of productivity growth, for sure, given that the base is a lot lower, and there are technological changes and the productivity ability to do these productive changes are much better in emerging markets. Generally, they leads to and it should lead to a better flows in terms of emerging markets at margin. So both from a valuation perspective and both from an argument of real yield and relative productivity growth perspective, emerging markets stands much better than what otherwise the pivot would not have been done. You have to also look in this context that for the growth to become better or the rate of growth to become better in emerging markets, the basic catalyst was missing in the sense that the fiscal policies have been quite conservative, monetary policies have been quite conservative, and currency channel was very, very tight. At margin, that changes in favor of emerging markets, and history suggests that whenever things like this has happened, at least in short to medium term, it has led to very large flows. So, which
Kaustubh,
is what
my
markets are
follow-up
rejoicing.
question here would be, allow me to interrupt you here. Bond yields in US have come down from 5% to sub 4% in the morning when I checked. Is there a way we can establish that this move, what has been indicated by Fed, is something which is already priced in or it is not priced out? Let's say before the Fed meeting, even I was a bit puzzled that ye kya ho gaya? 100 bips decline out of the blue. Maybe markets saw this was coming.
So look, it is not that out of the blues. Some portion of this market was already pricing in, which is why you will see that over last 45-50 days, USTs which 10-year UST which touched at 5%, it was already trading at closer to 415, 420, because market were looking at this data and they were actually speculating that at some point of time in next year, Fed will get into this comfort zone of that inflation is normalized and they will cut rates. It's just that yesterday the messaging was so dovish that the markets are becoming a lot more confident, and which is why we have seen yields rallying by another 15 to 25 basis points between yesterday and today. But large part of the move, as you rightly said, markets are already pricing in. The job of the market is to preempt policymakers, which they are doing as of now. The policymakers have finally given up, like what markets gave up in 2022 when markets were not sure of that rates will remain higher for longer, but Fed clearly convinced market that rates will remain higher for longer. This time markets are pricing that Fed will eventually ease. This time Fed has given, or rather policymaker has given, that they are now eyeing for soft landing, and which means that they will cut rates in line with markets. They are pricing too much of rate cuts. Markets are pricing 5 rate cuts by Fed in 2024. Fed is getting 3. If we look at a growth inflation rate in the US, we think that Fed will give up and they will actually cut somewhere between what markets are pricing in or what Fed is pricing in.
Fantastic. And there is a new fund which we know from Birla, where if you want to bet on the downtick, well, you can go and subscribe. It's a very nicely timed fund, I must say. That's of course so lovely to have you on ET Now. Thank you for joining us.